Here's something they never taught you in school. You've been playing a game your entire adult life, and most people don't even know the rules. They just know their score. They track it the way they track their weight or their GPA. This one number, somewhere between 300 and 850, that seems to control whether you get the apartment, whether you qualify for the car, whether the mortgage goes through. And for most people, that number creates this constant low grade anxiety, this feeling like you're being graded on something you don't fully understand. And here's what I need you to hear: that feeling isn't an accident. Today, we're going to look at the credit score from a completely different angle. Not just how to raise your number, but who built this system, how it profits from your behavior, and what you can do to use it strategically. Because once you see the mechanics behind the number, you stop letting fear run your decisions, and that's when things start to shift. The mistake most people make is treating the credit score like a neutral, objective measure of financial responsibility. And honestly, that belief makes sense. You pay your bills on time, you handle your money carefully, the system rewards you. Sounds like a fair deal? But here's what rarely gets talked about. The credit score was not designed to help you, it was designed to help lenders. The FICO score was introduced in 1989 by the Fair Isaac Corporation so that banks could more efficiently sort borrowers into risk tiers and charge them accordingly. It was built by the lending industry, for the lending industry, maintained by a company that earns revenue every single time a lender pulls your score. So when you spend years anxiously optimizing this number without understanding what drives it, you're playing someone else's game, by someone else's rules, for someone else's benefit. The goal today is to understand those rules so you can stop reacting out of fear and start playing strategically. So let's get into how this actually works. FICO scores are calculated using five main factors: payment history at 35%, credit utilization at 30%, length of credit history at 15%, new credit inquiries at 10%, and credit mix at 10%. Pay on time, don't max your cards, keep your oldest accounts open. Simple enough. But when you look at how these factors interact with the way lenders make money, something more interesting comes into focus. Start with credit utilization, the percentage of available credit you're using at any given time. The common advice is keep it under 30%. Fine advice, but here's the layer most people never see. If you're carrying a balance month to month, the bank isn't just reading a risk signal, they're actively collecting interest from you. And the rate they charge is directly tied to where your score lands. As of February 2026, the average credit card rate sits around 21.98% to 22.83%. If your score falls in the fair range, 580 to 669, you're likely facing 24 to 28% APR. Poor territory can reach as high as 36%. Now compare that to someone with excellent credit, 740 or above, who might access rates between 17% and 21%. On the average American credit card balance of around $5,600, that gap compounds month after month, quietly draining money out of your household. Mortgages make this even more visible. Borrowers with scores above 760 qualify for rates around 7.10% APR. Drop into the 700 to 759 range, and that edges up to about 7.70%. On a $400,000 loan, that 0.60% difference translates to roughly $164 more every single month, and across 30 years, that gap represents approximately $59,000 in additional interest paid. Let that land. $59,000, not because someone made reckless decisions, but because their score was 60 points lower than it could have been. The score isn't just a number, it's a price tag, and that price tag gets stamped on nearly every major financial decision of your life. Now, here's where the hidden system piece comes in. The FICO company is a publicly traded business that earns revenue by selling your score to lenders every single time it gets checked. Mortgage lenders, auto lenders, credit card issuers, landlords, and in some states, employers all pay to pull it. FICO's leadership renegotiated contracts with credit bureaus to push through systematic price increases. Those get passed to borrowers through closing costs and origination fees. FICO is used by approximately 90% of top lenders, giving them near monopoly control over a system most Americans don't realize is profit-driven. And the feed layer is its own story. American families paid over $17 billion in credit card late fees in 2024, a 13% increase over 2022, hitting lower score borrowers hardest. The cycle looks like this: lower scores lead to higher rates make balances harder to pay down, missed payments push scores lower, which keeps rates high. It's a loop, and the loop is profitable. Understanding that loop is the beginning of breaking it. Here's the trap that keeps people stuck. They treat improving their credit score as the actual goal. They check it weekly, celebrate every jump, avoid anything that might cause a dip. But that's anxiety management, not wealth building. A high credit score is not wealth, it's a cost reduction tool. It lowers the price of money when you need to borrow it. The actual wealth gets built from what you do with those lower costs. Someone who sees this clearly secures a lower mortgage rate, keeps more income instead of surrendering it to interest, and redirects that difference into investments that compound over decades. Someone who doesn't uses a high score as permission to take on more debt. Same number, completely different outcome. Once you stop treating the score as a grade and start treating it as a lever you control, you make decisions that actually compound into something real. 3 specific moves that will strengthen your score and make it work for you. First, target utilization below 10%, not the commonly cited 30%. Pay down balances, keep monthly usage low, and resist canceling old accounts. Keeping them open lowers your utilization ratio without changing your spending. The length of credit history factor rewards you simply for leaving old accounts active. Second, fully automate your payment history. Since payment history is 35% of your score, one missed payment can undo months of progress. Set up autopay for at least the minimum, then manually pay the full balance before the due date. Forgetfulness under financial stress is one of the most expensive behavioral patterns in personal finance. Automation removes it with a one-time setup. Third, once rates drop as your score improves, treat freed up cash as capital. The 2026 Roth IRA limit is $7,500 per year, or $8,600 if you're 50 or older. Roth money grows tax-free, and qualified withdrawals in retirement are untaxed. Pair that with a high-yield savings account. February 2026 rates run 4 to 5% versus near zero at most major banks. That gap compounds every day in your favor. Here's where I want to leave you. This system wasn't built to serve you, it was built to serve lenders. But knowing how it works puts you in a completely different position. You can stop chasing the number out of anxiety and start using it as a tool that reduces borrowing costs and opens options unavailable to people who don't understand the rules. The gap between someone who sees this clearly and someone who doesn't compounds wider every year, just like interest. I'm not a financial advisor, and this is educational, but understanding the mechanics of the system you live inside is where every smart financial decision starts. If this shifted how you see the credit score game, subscribe so you don't miss what's coming next. Drop a comment below. What's one thing about your credit score you've always wondered but never gotten a straight answer on? I read every single one.